Hello everyone, this is TobeTada with another video of crypto trading. Thanks for checking by and let's dive right in. So for today's video I thought we'd do something a little bit different, and that is basically by looking at what I would call a compound interest trading strategy. And what I mean by that is that I guess first of all we'd have to understand what compound interest is, and the other thing is that this is what I would call a relatively safe trading strategy, of course, with the usual risks attached to it, but let me show you what I mean by this. So basically by looking at compound interest, this is the idea that if you have $100 and you invest this with for example, as a 1.01 or 1%, it doesn't matter where you invest it, or so you get a 1% return here. This is what this 0.01 stands for, or 1%, and you basically get, as you can see, $1 return. So you can see $100 times 1% is €1 or $1, whatever your currency is. And the idea of compound interest is that you take this $1 and basically invest it into this 100, so you'd have a $101, and again you have basically multiply this by 1%, the percentage stays the same, and your answer is 1.01. And then again, you basically feed this into your initial amount here, which added by the previous amount of $1, so you get basically 102.01. And then again, you multiply this by 1%, and you get $1.02. So basically that's the idea. And so you'd kind of put that into, add that to the 102.01 and multiply that by 1%, and so on and so on. And you can see that we did this basically 3 times here. And we can get the same result basically by putting it into a formula for compound interest, which would be the start value, the amount of money you invest basically, so $100, and you multiply that by 1.01. This is basically stands for 1 plus 1/100. So 1 plus 1% is 1.01, and you basically raise it to the power of 3. And in that case, you'd get 103.0301. So if you basically go back and look at this, and you add 102.01 plus 1.0201, you get exactly the same amount. So that's basically what compound interest is about. You can basically do it manually, which is definitely annoying after a while, or you use this formula, and that basically means that you have your investment times 1 plus 1/100, or in 2/100, depending on how much return you get, percentage return you get, and you multiply that by how often you do this. So in this case we did it 3 times. This could stand, for example, for in banking you usually get like if you get 1%, which is quite common nowadays, you'd get, of course, 100 times 1% is $1. And if you let that money in the bank, that would be basically for 3 years, you'd basically get here $103.03. with compound interest. So that's the idea of compound interest, and you can see that's a pretty terrible investment strategy, because you'd not really have anything to show after 3 years. In the bank, you'd basically have $3. So that's basically why not many people now do that today. Of course, in the past, we could say now that, for example, you get if you go a little bit back, you might have gotten perhaps 6%. So you'd write 1.06 for 1 plus 6%. And if we basically raise that to the power of, again, 3, you'd get $119, almost $120. So with 6% and 3 years, you'd get almost $20 of profit here. And of course, you could change the start value by add another 0, and you'd have 1,000 times 1.06 to the 3rd power, and you can see your profit would have been almost $200. So that of course increases if you increase your starting value, or the percentage, or the number of times you do this operation, in this case 3 years. So if we apply this insight into trading, this basically means that if you use compound interest, this can get very interesting, because we're looking at basically the number of times we do this. So the power, the number up here is basically can get very high. Actually, this is basically I would say the secret by using this in the charting. So let me give you an example. If you have, let's say $500, which is I guess a lot of people have that lying around somewhere. It's not too much, it's not too little, but you can do, of course, the same thing with $100 or so. And you basically say that you get a 1% profit here with charting. And let's have a look. What I mean by that is basically, if you look at Bitcoin here now, you can say, okay, for example, if you're very lucky or a very good trader, you invested, for example, here, this point, and then you basically can even say how long you had to wait. Basically 1%, that would have been about 12 hours you had to wait here until you get about this percent here. So you can see that this is basically, I'll do it like this, it's not too much. Of course, there's the risk that you'd invest at a point, for example, up here, and you'd face a loss of 0.5%. Of course, that now goes into the charting area, and what could help you to make that investment go positive and invest it so you don't have a 1% loss. But I think we'll cover that in another video. For now, let's just have a look at this and say you have a 1% gain here. And what that means is, in this compound interest trading strategy, is that you're basically finished, let's say, for a day. You can sit back, enjoy the day, and don't have to worry about your stocks anymore, because you have made that 1%, which is our daily goal here. And of course, now the interesting part is how often you do this. And because this is, I think, an achievable goal of 1% a day, you can also, I guess, say that, for example, if you do this over 1 year or 365 times, that you actually get quite a very large return if you look at it this way. So you have $500, every day you get 1% from $500, and you basically do this 365 times, or over 1 year, And at the end of that year, you'd have $18,892 from the $500. So that's quite a significant return. And that is basically the power of compound interest. And I think a lot of people might not still understand that. For example, if we look at, I guess we could make this as an example, another example here, by having $100, and you say you have, the question is it better to have $100 and you get a one-time gain of 10% or 0.1, or if you have that 10% spread out over 10 days? And I think a lot of people would answer that this would be basically the same or not change a lot, which is somewhat true for this example, as I'll show you. You basically have this answer. So you'd have one time, the idea is you get one time 10%, so you get $10 profit, or $110 at the end. The other times you get every day 1% over 10 days, and at the end you have 110 and 46 cents. So that's not too significant right here, but basically I want to show you in this example that compound interest works much better for you than if you have a single return. And basically what that compound interest strategy then would suggest is that you try to basically keep the gain of over a day quite low, and do this a lot of times. That's basically the idea of it. And we'd of course have to talk about how we get this 1%. And interestingly, if we look at, for example, if what happens if we do a 1.15, so that would basically mean 1.5%. It's only 0.5% more. But if we do this for a year, I guess I did something wrong here. Yes. That is definitely not right. So 500 times 1.015. So I forgot a zero here, and you get a very large increase. So if we do this here, is that correct? Let me see. That seems crazy, but I think it is right. So you'd get, basically, by having 0.5% more every day, you'd end up with a $114,000. So let's just double check if we did it right. So 500 times 1.01, so for 1%. And indeed, you can see it's 18,000, and only by changing this by 0.5%, as you can see here with this 5, this increases exponentially. So instead of 18 or almost 20,000, you get almost 120,000 after a year. So that's like 6 times more. And I think that's really what's quite mind-blowing in my opinion. So if you go back again and say $500 times, let's say 1.2%. So 1.012 to the power of 365, you'd have almost $40,000. So just by, again, increasing your profit by 0.2%, you'd actually make double amount of money at the end of the year. And so basically, at least I found that pretty insightful and quite mind-blowing, quite frankly. And I guess now the idea is, if you're thinking about investing or as your main strategy, you'd have to figure out how you get this 1%, or 1.2%. And we're going to talk about that in the next video. So for now, this is just an update on the strategy. I don't know if probably a lot of other people who looked at this and so on, but I haven't heard it in the internet so far explicitly. So I thought I'd share that, and let me know what you think about this, and see you next time. Bye.